Welcome back. This section is going to be about bull-put spreads. We're on page 23 of your manual. We're going to review the selling rules of bull-put spreads. Do you remember these from the Wall Street Workshop? You should have these memorized by now. You only sell puts when what? Say them out to me. When you like the company, right? You like that? You don't sell puts and agree to take a stock unless you want that stock, right? And you like it at that price. So those are the basic two rules of writing puts. You like the company and you like it at that price. Now, that is selling naked puts, selling uncovered puts. Do you know there is a definition? There is such a thing. It's so rare that is called selling covered puts. Let me give you the definition. Write it down. If you don't understand it, that is perfectly fine. You'll probably never use it. Writing a covered put means that you are short on the stock. You're in a short sell position on the stock. Writing a covered put means that you're short on the stock. Then, if you get the stock put to you, right, written a put, if you get the stock put to you, what does that put stock do now? It just fulfills your obligation to repay the stock. Okay? Kind of a technical definition, but that's a definition of a covered put. All right? Now, because you'll hardly ever use that, let's keep moving on. One of the problems with writing puts in page 23, there are really two problems. The problems are, one, is that your stockbrokers just simply will not let you do it. You come into a class, you learn all about selling puts, you're really excited about it. You walk into your stockbroker's office and you say, oh, I would really like to write some puts on Microsoft. And your stockbroker says, what? How many of you been there before? Your stockbroker says, what? No. You can't do that in your account? No. You don't have enough experience? No. We will not allow you to do that. The irony of all ironies is coming up here just very shortly. But it's so funny because, do you remember when you filled out the brokerage account statement, the trade in your account, and they want to know what kind of trading you're going to do? Buy stock and mutual funds and write covered calls. Remember that? And there's like number 5 or 6 or 7 down there. What was the last one on the whole list? It was sell, but it didn't say sell puts. It said sell naked puts, right? Therefore, it sounds like the riskiest. And to the typical stockbroker, it might be because they don't understand it. I personally think it should be up there around number 2 or number 3 for safety, if you do it right, if you learn how to do it right. Selling puts should be a great strategy that everybody does. It's a way of buying stock wholesale. It's a way of generating cash, et cetera, et cetera, et cetera. But you go into your stockbroker's office, say, I want to write puts, and they'll say, sorry, you can't do that. If you so you're kind of depressed and you walk out and you say, man, okay, how about if I do a bull put spread? And they'll say, yep, sit down here, take it. How many contracts do you want to do? How come they'll let you do bull put spreads and they will not let you sell puts? We need to explore that. Before we explore that, though, let's explore another situation, which I think is the irony of all ironies in the stock market. You walk in there and tell them you want to sell on Microsoft, which is going around for around $80, that you want to sell the $80 put for next month or whatever. Microsoft is going for, that put is going for $4 or whatever. You take in $4,000, right? Why won't they let you do this? Because they say it's risky. What is the risk here? What is the risk here? Do you understand that when you're in a sold put position, it is the same as owning the stock, right? The risk is the same as owning the stock, is it not? Because if that stock tanks down to 70, down to 60, down to 50, down to 40, and you get it put to you at 80, you've got the same loss as if you owned the stock at 80 and went down to 40. Well, isn't this amazing? They will not let you sell the put on the $80 stock, but if you say, okay, well, how about if I just buy the stock? Sure, go ahead and do that. See, stockbrokers will get you into risky things all day long. They'll let you buy the $80 stock, but they won't let you do the same transaction as selling the put and putting up even less of the money at this current time. It just does not make sense. They don't get it. You ever do business with people who don't get it? They'll let you do this incredibly risky deal, but they won't let you do this so-called risky deal. It's amazing to me. All right, so that is a problem. I've already talked about cleaning the house, about buying back those options. We need to now review margin in 24 before we can understand bull put spreads. This is a very important part of this. Here we go. Review our margin requirements. In the Wall Street Workshop, up until now, in the new Wall Street Workshop, we are now really going through the margin requirements and what it costs you. I'm going to share with you for the next 5 or 10 minutes so it'll keep you out of trouble. So you won't be out doing deals and putting up money and then having your stockbroker call you and say, you need to bring in another $4,000, right? You have a margin call to stop all that kind of stuff and to stop the riskiness. I think you need to understand exactly what margin is. So let's go through this. Our example, as it says on page 24, is we're going to sell the $80 put. This was an example that I used this morning. The stock has dipped down to $86, and we're hoping that it goes back up. We sell the put for $3 or $3,000. We take in $3,000. Now, there are three things that are going to be on hold. One of them is just the hold amount, and the other two represent margin. Let's go down through these three things. Number one, the amount on hold will be the premium. You have to hold in your account until expiration or until the deal is over with. You have to hold the premium. In this example, the $3,000. You have to have that in your account. Now, 2 and 3. You see that? There's an or between them. And whichever is the greater off to the right there. Number 2, they're going to require you to have on hold 20% of the stock price. Please look at that again. I am not saying 20% of the strike price. I am saying of the current price of the stock. In this example, the stock is at $86. So how much? How much, everyone? Was 20% of 86? We're doing 1,000 shares, remember? So it's $17,200. Now, we get an adjustment. See that minus sign right there? We get an adjustment for any out of the money portion, any portion over the strike price. Well, the stock's at 86. The strike price is at 80. How much is out of the money? $6 or $6,000. So we get to subtract from the $17,200, $6,000. So we have to have on hold in our account $11,200 plus the $3,000. You see, that premium is on hold no matter what. No matter what the margin does, you have to hold the premium in your account. So that total then would be $14,200 in this example. Or number 3. Number 3 would be 10% of the stock price plus the $3,000. Stock price is at $86,000. 10% would be $8,600 plus the $3,000. So it'd be $11,600 or $14,200, whichever is greater. So it's going to be on hold in your account for you to sell this put on this $80 stock will be which one? Obviously, the $14,200. Do you see how that works? The $14,200. So that is what will be on hold in your account to do this, sell this $80 put for $3. See how that works? Now, we're not done yet. What happens, see, you don't get in trouble here because they can calculate this at the very beginning. The question is, what happens if the stock goes up? And what happens if the stock goes down? All right, so let's do what happens if the stock goes down first of all. So let's go over here now to this side, and we'll do down. If the stock goes down, what happens? Let's say the stock drops all the way down to $76. All right, let's do it again. Number 1 will be the $3,000. You have to have that no matter what. Number 2, okay, let's see if you've got this memorized yet. You got to memorize this, everyone. This is a part that you can't have this piece of paper with you when you're driving in your car, right? So it's going to be the amount of premium plus 20% of what? Of the stock price, which in this case now is 76. So that's how much? 15,200. Now, 20% of that equals 15,200. Uh-oh. Now we get an adjustment for. We get to subtract any out of the money portion. Whoa, what's the problem? We're in the money now. This stock price is now below the strike price. Now, remember back in 8th grade or 7th grade when you studied this in math about subtracting a negative? When you minus a negative, what does it turn into? A positive. So when you subtract a negative $4,000, right? Y'all see where the 4,000 is coming from? 76 and 80, right? That's $4,000 in the money now as a put. So you get to subtract a negative 4,000, so that becomes a positive. So it's 19,200 plus the 3,000, $22,200. Or number 3. Number 3. What's number 3, everyone? 10% of what? So 10% is 7,600 plus the 3,000 is 10,600. Whichever is greater. Which one of those two is greater, 2 or 3? Obviously, 2 again. Do you see that because the stock has gone down, your margin requirements have gone up? If the stock drops below $80, is there a higher likelihood that you're going to get the stock put to you at 80, yes or no? Okay, you didn't answer the question, so let me ask again. If the stock drops below $80 and you have an $80 put written on it, is there a higher likelihood now that this stock is going to get put to you at 80? Yes. Therefore, they're going to make you hold more money in your account, right, to meet up with your obligation. You see how that works? Well, let's go the other way now. Let's say now that the stock goes up. The stock goes up. Same $86 stock. Now the stock goes up to $93. Ooh, let's go there. That's fun. We have the $80 put written. That's for the 3,000. Okay, let's go back to our formula again. Number one, we have to keep that $3,000 in the account until the expiration or until you expire this deal, until you end it. Okay, until your obligation is over. Number two, 20% of the stock. Ooh, this is interesting. 20% of what now? 93,000. 18,600, but we get a credit for any out of the money portion. How much is now out of the money? The put price is 80. The stock price is 93. How much, everyone? $13. $13,000. So we get a credit in this example for $13,000. That's $5,600 plus the $3,000 is $8,600. Or, now this is where the or comes in. This is where number 3 will kick in. If the stock significantly rises, do you all see that the stock could be so far out of the money that you could get a credit bigger than the other part of it? You see the point? They could end up owing you money. And they're just not going to allow that to happen. So there's like a catch-all thing. This 10% is a catch-all. What's 10% of what? Do it for me, everyone. 10% of what? 93,000 is 9,000. So the 10% is where it kicks in now. 9,300 plus the 3,000. So it's 12,300 or 8,600, whichever is greater. So do you see now that they're going to make you still hold the 12,003? You see how this works? Now, does this example of margin help you decide a few things and to keep you out of trouble? Because see, if you are worried about a margin call, maybe you shouldn't have done 10 contracts. Maybe you should have only done 7 or 6. You see that if you don't have enough cash to bring in if the stock goes down. All right, that is margin requirements for writing a naked put. Now, we're going to now go over to page 25, and we're going to do examples of bull put spreads. Do you want to go ahead and start getting somebody on? I'm going to do an example A while they're getting somebody on the phone. Let me know as soon as you have somebody, all right? Example A, I'm going to make one up. Okay, Microsoft. Stock's around 80.5, right? So let me show you what we're going to do now with Microsoft. You got some prices on it right there, David? The stock was around 80.5, was it not, today? Here's what we're going to do. We're going to look at the $80 put and the $75 put. The $80 put, let's say, is going for $3. And the $75 put for June is going for $1. That'd be a nice deal. Here's what we'll do. We will sell this one, and we will buy this one. Oh, now why? We'll explore the numbers here in just a minute. Why are we spending that money to buy the $75 put? It's insurance. It's our hedge, right? It's insurance. That's the best word of them, because here's the deal. We have now sold a put. If we did not buy the $75 put and we sold that $80 put, what is our downside? Let me say it again. Okay, if you're not answering, I don't know if you're with me. If you're selling that $80 put, what's your downside? $80. That can go clear down to 0. But what would happen if that stock dropped, in theory, and you were long the $75 put? As that stock dropped down to 60, to 50, to 40, what would happen to that $75 put? It, in theory, would go up in value. All right, the point is this. In a bull put spread, we sell the higher put, we buy the lower put, right? Now look at this. Look at this. If we sell this one for 3 and we do 10 contracts, that's $3,000, correct? If we spend $1 and buy this one, what have we done, everyone? Have we added money to our account, or have we taken money out of our account to do this deal? We've added. This is called a credit spread. A credit spread means that we're taking in money. A debit spread means we're what? Spending money. So in this example here, we've sold the 80 for 3. We've taken in $3,000. But out of that 3, which is kind of interesting, by the way, because whose $3 is that? Who gave us that $3? It's the market that gave us that $3. And out of that $3, we spent 1,000 of that to buy the 75. We have now created a $5 spread, a bull put spread. We're bullish. We want this stock to do what? To do what? It doesn't even have to go up. It just needs to stay up above what? $80. We do not want to get it put to us. Did y'all catch that? We do not want this stock going below 80. All right, now, to see how this works, let's flip the page where we can just go out and see what happens. Oh, where'd it go? Well, we'll do it right there. We'll do it right beside it. Here's the question. What happens on expiration? The stock has even risen up to $81 on June 15th or whatever expiration date is, June 17th, whatever it is. Everything expires. Tell me, if the stock's at 81 and you've sold the $80 put on the expiration date, what's going to happen to that $80 put? It'll just expire, and nobody's going to put you the stock because it's above 80. So do you get to keep that money? Yes or no? Yes. What about that $75 put? Is it worth anything? Not if the stock's at 81 on expiration date, a $70 put's going to be worth 0. That's just going to expire. So this example here, you have 2 options expiring worthless. Do you not? And what do you get to keep in the meantime? The $2,000. All right, what is your hold? What is your hold? What is your margin? What are they going to make you keep on hold to do this deal? They're going to make you keep the amount of the spread, or $5,000 minus what you took in. Let me say that again. The amount on hold in your account. The amount on hold will be the amount of the spread. If we're doing 10 contracts on a $10 contracts on a $5 spread, how much, everyone? 5,000, but we took in 2,000. Yes or no? You like it or not? So we got $3,000 on hold in our account to make how much? So we got 3 on hold to make 2. How many like this deal or not? How many like the deal that you're not having to pay 2 sets of commissions? Okay, let me say it again. Debit spreads equals 2 sets of commissions or 4 commissions. Credit spreads, if they work right, equal 1 set of commission or 2 commissions. 1 set, 2 commissions. That's why I do probably 100 bull put spreads to every 1 bull call spread. That's why all day long on Win, you will see me doing bull put spreads. I like them. You catch the dip. You generate cash into your account. What about my downside? What if this stock just falls out of bed from $80 down to 60? How much can I lose, everyone? The $3,000. I can lose the $5,000, but how much have I taken in? 2, so I can net lose then $3,000. Y'all see that? So we have a limited downside risk by doing a spread, right? We bought that lower strike price put for hedge, for insurance. If that stock drops, we're out, but we only lose $5,000, but we took in $2,000, so we only have a net loss now of $3,000. How many like this one, by the way? Okay, we got somebody ready to go? Okay, who's there?
Wade, Richard.
Richard, hello.
Hello, Wade.
How the heck are you? How's the wife and kids?
Doing great, sir. How are you?
Good. All right, we're doing bull put spreads right now. Just for fun, can we do Microsoft?
Okay.
Microsoft June, bull put spread, 75.80. What's the stock at right now, by the way?
Okay, it's coming up. It's at 80 even, down a quarter.
We like them on dips, by the way. Start writing some of these rules down. We want to get these on dips when they're going to go back up. Now, we don't know if Microsoft's going back up. We hope it is. Okay, what is the 75 and the $80 puts going for?
Okay, June 75 puts are 3/8 by a half.
Okay, and the 80s?
The 80 puts are 1 and 5. Pardon me, just changed. 1 3/4 by 2.
Okay, good. 1 3/4 by 2. Here we go, everyone. We sell this one. We buy this one. Okay, let's do it. Let's do the numbers. We're going to sell this one for 10 contracts, $1,750. We're going to spend the money and buy this one for $500. We're going to take in $1,250, right? That's cash into the account. Now, what's the other side of that? What's on hold now? The $5,000 hold minus that $1,250. So the amount on hold, the amount at risk, is $3,750 to make $1,200. How many think that's an okay deal but it's risky? Is it not? Because Microsoft could easily drop below $80. Let's move down a strike price. Let's go down to, Richard, can I get the 70s and 75s for June on Microsoft?
Right, Wade. The June 70 puts are 1/16 by 1/8.
And the 75s are still the 3/8 by 1/2?
Yes.
Okay, here's we go, everyone. We're going to sell this one and buy this one. Does everybody see that it's a quarter? Not very much money here. Does everybody see the quarter or not? Do I have to do it, or do you want me to do it? You want me to do it? Okay, $375, $125, $250. So we're going to put up $4,750 at risk to make $250. And after commissions, we're going to have about $150 left. Not probably worth it, but not very much risk either. Y'all see the point? Because Microsoft would have to drop below 75 and stay below 75 on the expiration date, which is 10 days away. You see the point? And it's kind of coming into its newsy period of time. You see the point? All right, so I like the 75-80. Let's shop around. Can we do IBM for a quick sec?
Sure. Coming up.
Okay, this should be your example C on page 25 now.
Okay.
IBM.
IBM is at 116.5. That's down 4.
Wasn't it 118 when we called in earlier? Okay. What are the, well, okay. So I'm gonna show you a comparison. Matter of fact, you know what comparison I want you to see? I want you to see the 110, 115, and then if you're really bullish on IBM, I want you to see the 115, 120. There'll be a lot of money there, right? But again, do we want the stock to get put to us or not? Yes or no? No. So by selling the 120 and the stock's at 116, could we get it put to us even early? Okay, what are the 110, 115s going for?
Okay, the June 110 puts are 5/8 by 3/4.
Okay, and the 115s?
The 115 puts are 1 7/8 by 2 1/8.
Okay, and the 120s?
And the June 120 puts are 4 5/8 by 4 7/8.
Ooh, look at this, guys. 4 7/8, did you say?
Right.
Okay, let's do the 110, 115 first. Okay, we're going to sell this one, buy this one. $1,875 and $750. We're going to generate on a bull put spread $1,250 into our account. We'll have on hold $3,750. That is the amount of margin, that is the amount at risk, if you will, to make $1,250. But we need IBM to stay above 115. Nice deal, maybe, as long as we're confident that it's going to go back up. I'm not that confident it's going to go back up. But let's say that we really were. Let's say that we were really bullish. I'm not, by the way. But let's say we're really, really bullish on IBM in the short term. Got 10 days. And you think it's going to go back above 120, right? It just did the split. Didn't IBM get up around 260 before this 2-for-1 split?
Yeah, that's right, Wade.
Yeah, and it's back down to the 120 range, which is like the 115 range, which is like 230, right? It's, I mean, a pre-split price. So it's like $50 or $30, $40 under where it was. Big dip after the split. But let's say that you're really, really bullish on this thing. You really, really think it's going to go back up. Watch this. You sell the 120, you buy this one. You take in $4,625. That's the amount in. You sell this one for $2,125. Look at this. $2,500, and you have on hold in your account $2,500. That is 100% return on your money, and all you need IBM to do is go do what? Go back up $4 and get above that 120. You like it or not? It all depends on if you're bullish on IBM or not. Y'all see the point? My goodness, guys, listen carefully. We do these puts, bull put spreads, slightly out of the money. If you want to do them in the money, right, where the stock is below the strike price, the highest strike price, man, you can make tons of money. Lots of risk, right? Lots of risk. Okay, what do you have at risk here? If IBM tanks and goes down to 114, look at this one over here. If IBM tanks, you're going to lose your $2,500. Y'all see that? You're going to lose $5,000, but you took in $2,500. Here, you've got more padding, right? You got the 115 and the stock's at 116, 118 range. You see the point? You make less money, but a little bit more security. Okay, let's do another one. You get it now? You sell the higher put, you buy the lower put for insurance. You create a spread. The amount you can lose is the amount of the spread minus the cash that you generated, the cash that you took in. And you do not want to get this stock put to you. So we only do these when we're in a bullish position on the stock. Y'all see that? We only do this when we think it's going to go up. Okay, so anybody got a stock right now they think it's going to go up? How about that Ameritrade? I think Ameritrade's going to go up, right? Coming into a 3-for-1 split. And it's down right now because it went up like $5, $6 yesterday. Had a nice run yesterday. Okay, what was the ticker symbol again? AMTD? Let's check the 7580s, and let's check the 8085s. Okay, which one's going to be more profitable if it works? 8085, I'm sorry. Yeah, 8085s. More security, less profits. Over here. Y'all see that? Okay, let's do the 75 and 80s first of all.
Okay, the June 75 puts are 2.5 by 3.
Okay.
The June 80 puts are 3 7/8 by 4 3/8.
Okay. Okay, give me the 85.
And the June 85 puts are 6.5 by 7.
Okay, let's do them all. Okay, we're gonna sell this one, buy this one. $3,875. We spend the money. We buy this one for the 3, which is $3,000. That's $875. So we could net profit on this $5,000 spread. We could net profit $875. We'd have to have $4,125 on hold, right, to make $875. Over here, even though the stock's slightly above the highest strike price, it's a little bit riskier, but look at the profits that will be made now. Okay, we sell this one, we buy this one. Okay, here we go. We sell this one, $6,500. We buy this one for $4,375. My goodness, look at this deal. $2,125 profit. How much on hold? How much on hold, everyone? The other side of that, which is $2,875, right? What do you think? Nice profit. It's about an 80% return on your money. Now, guys, this is what I'm trying to tell you. When you get good at this bull put spreads, if you really think Ameritrade's going to go back up, you do this bull put spread on Ameritrade, you're looking at $2,100 profit on $2,800 that you put up. That's an 80% return. So when I tell you that you can take $25,000 and make $15,000 a month, are you starting to see it? On doing these bull put spreads, that's what it will generate. Okay, let's do one more, and then I'll show you how that works as a group. And we'll come back after the next session. We'll do a little Q&A on this so we can get all your questions answered. Okay, keep going on examples. What does the margin hold equal on these? Richard?
Yes, sir.
Do you guys have one that you've been working there today on a bull put spread?
We have not been
I did one this morning. Let's check CMGI. I think David did CMGI today, didn't you, David? Okay, would you get the numbers ready on CMGI? I'm going to spend just a minute with the class. Okay, top page 26. What does the margin hold? What is it, everyone? It is the amount of the spread minus the cash you took in, because this is a credit spread. What is your risk then? Same thing. The risk, everyone, is the opposite side of what you took in. It is the $5,000 minus, so if it's $3,000 from $5,000, that'd be $2,000 or whatever. You see the point? It's the opposite side of the $5,000. So that's the amount at risk. All right? Now, why are we doing this? We're doing this to generate income. It just generates cash into your account, spendable cash that you can spend every Monday after the expiration if you let them all expire. I'm not saying you should let them all expire. You may want to wind out of them before. But the main advantage of doing bull put spreads as compared to bull call spreads is what? If you think it through, what is it? When you're generating money, the other one you're spending money, that's okay. But when it comes down to the bottom line, what's going to shake out is your profit minus all your expenses. That other second set of commissions, right, is very, very costly. And so that's why I do bull put spreads, is because there's only one set of commissions. I keep harping on that, but it is so important. And if you guys don't learn that here in class, guess when you're going to have to learn it? Out there in the real world, when you're doing a whole bunch of bull call spreads and you're making $800 here and $1,200 there, but you're only, that's $2,000 profit, but you only end up with $1,400 in your account. Right? Seriously, out of $2,000 profit, then you wonder why you're not getting ahead very fast. Then you'll click over and you'll start doing bull put spreads, right? Because you generate income and you limit your downside. So once again, we have an investment, a strategy type, where we know the risk and we know the reward before we get involved. All right, now, if it expires, we just get to keep our money. But let's go up to the top of page 27. What if it does go down? What if in our example, like on Microsoft, for example, the stock was around $80 and it goes down? And we had done the 75, 80 bull put spreads. Anybody got those numbers again for me? What did we do that one for? Anybody got their notes there? The 75, just a minute. That's the call, I think. Yeah, it wasn't like 1 3/8 or something like that? So it was $1,250, what you're saying is what we netted, right? Our credit was $1,250, right? So we had $3,750 on hold or at risk to make $1,200. And again, you understand that you can lose the whole $3,700? Yes or no? Do you understand that? So you're willing to say, I'm willing to risk that $3,750 to make $1,250, right? It's just like, this to me is more like buying a battery in a battery store and saying, I'm going to buy this bunch of batteries and try to sell them. If you don't sell them, you don't make any money. If they become worthless, you don't make any money. Y'all see the point there? If you sell them, if it works, you make money. All right, now, what if the stock, though, drops down to $79? First of all, do you have the risk right now of getting this stock put to you? Yes or no? Yes. Now, I got to make this sure that you are emphatically clear on this, that you cannot misunderstand this point. You have sold a put. You can get this stock put to you any time before the expiration date. Did y'all catch that? Now, in theory, the way it would work is you would get it put to you at 80 and you'd put it to somebody else at 75. That's kind of weird. So what do? If the stock goes down, what do? It's sitting there at 79. You're like 2 or 3 days before expiration. What do? You wind out of it. What does to wind out mean? You sold the 80. Now what do, everyone? You buy back. What if that cost you $2? Ooh, that's interesting. It cost you $2. You only made $1,250, right? You got $2, but guess what? The 75 is going for $1, right? Because the stock dropped down to 77 or 78. Do you see the point there? So you buy back the 80 and you end the obligation, and then you sell the 75. By the way, what if you did it the other way around? What if you went ahead and sold the 70 really fast or the 75 really fast? Problem? What's the problem? If you sell, you are naked now. You've now written a naked put. And some of your stockbrokers won't let you do that. You see what you just did? So which position do you have to unwind out of first? First of all, you just tell your stockbroker to do it, and they'll do it right. You just have them to wind out of the whole position, and they'll do it right. But if you're doing one leg at a time, which one would you have to do? The obligation leg, right? In writing a call or in writing a put, when you're going to wind out, you wind out of your obligation side first, right? And if it continues to drop, then see, you don't even have to sell that that $75 put right now, right? You're long. You could wind out of the 80 if the stock continues to drop, like tomorrow. Maybe you could sell for $1.50 tomorrow instead of $1 today. You see the point as it gets closer to 75. And then as the time goes away, you're not going to sell for anything. So I usually tell you what I do, and you don't have to copy me on this, but I am so busy that I just tell my stockbrokers, get me out of, unwind it. Y'all see that? I don't have time to play around. I don't have time to buy back the 80 and hope for a little bit better deal on selling the 75 later on in the day. You see anybody else with me on that? So I just say, get me out of the whole deal. So they buy back the 80 and they sell the 75, and I'm totally out of the deal. What if that cost me $2,000? How much did I lose on this transaction? I made $1,250. Now it cost me $2,000 to undo the whole thing. What did I lose, everyone? $750. Right? You see, now let me make a major point on this. Just because the stock goes down does not mean that you're devoid of opportunities. Just because the stock goes down does not mean that you're going to lose that $5,000, or in this case here, that $3,750. You may only lose $500. You only may lose $700 because you still have the right to unwind out of it. If the $80 put goes up in value and it costs more to buy it back, in theory, the $75 put has gone up and you can sell it at a profit. You see how that works? So again, so that we're all together, what does wind out mean? It means to do the opposite, right, of what it did to wind in to the deal. That's how you get out of a spread. All right, now, Richard, do you have that one last one, and then we're going to break pretty quick here and go to lunch.
Yes, Wade. CMGI is at 105 3/8. That is
Hold
down.
it. Where was that a while ago?
It was at a high of about 113 this morning.
Today it was like 113, 115, wasn't it?
Right.
Wow. Okay, so it's backed off to 105?
Right.
All right, what are the, you know what I want to show you right now, everyone? I want to show you a $10 spread, because we've only been doing fives, and I think you need a little bit of diversity in your life. So let's do the 90 $100 June bull put spread.
Okay, the June 90 puts are 2 1/16 by 2 7/16.
Okay, and the 100s?
And the June 100 puts, 4 7/8 by 5 1/8.
Okay, so we sell this one, we buy this one. Y'all see that? Sell, buy. Now, $4,875. I hate 16ths. 2,000. We're going to get it for 3/8. Okay, we're gonna shop a little bit. Remember that, because we can tell our stockbrokers to shop. Okay, so 2,375, $2,500 on what? On 10. So what is on hold in the account? $7,500. How many think $7,500 on hold to make $2,500 is a pretty cool deal? But what we need what, though? See, it's a cool deal, but what? There's always, on the other side of the coin there. It's got to stay above what? It's got to stay above. Now, CMGI's already gone through their split. They came out with some awesome news this morning about one of the companies that they own, and the stock went up $5, $6, $7, $8, and it's already backed off. How fast does news play out, guys? It's like bad news plays out in about 3 months, seems like, right? Good news plays out in about 3 hours. Pretty amazing, isn't it? Up, and it's backed off already. Well, now on this dip here, we've got to see if it's consolidating here. We've got to see if it's heading into the next news period. We just don't jump in and do a deal until we check out all the scenario. Kind of like war, is it not? You see the target. You see that it's a pretty cool little radar site that you can go in there and bomb. But what you don't see is everything else around it. So you need to look at everything, right? You need to put it in perspective. You just don't run out after these targets because it looks good, because the numbers work. You've got to see if CMGI. So should you look at charts on CMGI? What do you think, everyone? To see where it's been, where it's going. Is it getting a support line on the bottom? You see my point? Is it coming into a news period? How does it news look? When is the board of, that's my question, by the way. I think the key question to everything in the stock market right now is, when is the board of directors meeting? Nothing happens until they meet.
By the way, Wade, something else. CMGI is scheduled to announce earnings this Thursday after the close.
Whoa. And what is the whisper numbers?
The consensus is a loss of 14 cents a share.
Have they been losing money lately?
Actually, lately they've been making a little bit of money.
See? Every time I start scouting around, it looked like a good deal, did it not? But all of a sudden we find out that, hey, they've been making money, but now it looks like they're going to announce a loss for this quarter. What does it tell you, everyone? A little bit scary, is it not? So if you do a bull put spread on this one and the stock's at 105, could that easily go below 100 and you get the stock put to you, yes or no? Okay, we're going to pick up after lunch and do CMGI as a bear call spread and show you how to play it going down. All right, thanks, everyone. Let's go ahead and break for lunch, all right?